Hey guys, welcome back to this channel. Today we'll be talking about bank reconciliation statements. So I'll try to explain this very quickly. As we know, companies do have cash book statements where they record daily cash transactions, and there's a bank statement which should always be the same. Normally, should be the same balances at any given period, but we know that is usually not the case, and the reason because of some transactions that are not recorded in either side of those statements. So bank reconciliation statement tends to give us clarity of the reason why that difference always occur. And some of the common transactions that usually cause that problem. Number one, we have a deposit in transit. That means money that cash that has already been recorded in the cash book, but is yet to be processed by bank. The bank has not recorded that transaction, but we have recorded it in our bank, in our cash book. So that will give a difference between the balance at the end of the month or the year. And outstanding checks is another issue. These are checks that the company has already issued to vendors or suppliers, but the supplier is yet to present that check to the bank. Having recorded it in the cash book as payment, the bank that transaction is yet to hit the bank, so we'll always have a difference deposit in transit. There will always be a difference between the bank and the cash book statement. Another issue is another transaction is bank charges. The bank in their own statements at the end of the month or sometimes after just a little bit after the month, they charge our account for their own services, whereas we have not recorded that transaction in the cash book. So that will also lead to imbalance between those statements. Another is interest income. Sometimes we receive interest in our account because of transactions. Bank will record that, but we're not aware of that transaction. So that will also lead to imbalance in those statements. Then the last one I'll quickly talk about is the NSA. That's not sufficient for not sufficient fund. These are like you have received the payment through checks and you have recorded that payment in your cash book. But later the bank has already recorded that. But later the bank discovered that the issuer, that is the person who gave you that check, does not have enough fund in their account. So the earlier credit to your bank will later be debited because the bank, they discover that that amount cannot, stay in your bank. So, but you have no idea of that transaction. You have already recorded an income in your cash book, but the bank has later, removed that money. So that will lead to imbalance in that in both statements. So these are some of the issues that lead to imbalances. So the essence of bank reconciliation statement is to look at those problems and then rectify so that we come to a true balance for both statements. So what are the steps you need to take to resolve this issue? Obviously, we know before we can do this, we need both statements, your uh, uh, um, the cash book statement and the bank statement for the same. I have extracted a question from the internet so that we can use to see how this is actually done. But of course, there's a template for reconciliation statement. You can always download it online and find out to be easier. But before that, you need to understand how this thing is being done. So first of all, before you attempt doing reconciliation statements, you need both bank and the cash book statement such that you look at the differences and write them out. What transaction appears in a statement and is not in the order, so you need to list them out. Just like this example is saying, this company is preparing a reconciliation statement at the end of the period, and this has the observation. Number one, the bank statement contains $300,000 as balance, whereas the cash book is saying 260,000. So there's a difference, and the reason for those differences are the reason for the difference are that the bank statement contains $100 service charge. So that is the charge that an expense the bank has already recorded, but the is yet to appear in our cash book. And then there's a statement of interest income. That's $20 income. that the bank has already recorded because they are the one that gave it, but we are yet to know about it, so we cannot record that in the banks in the cash book. So these are some of the differences that will occur. Now, for the aspect of the cash book, we have issued a check of 50,000 to a supplier or somebody else, but that check is yet to be presented at the bank. So this is an unpresented check. It will cause a problem. And a deposit of 20,000, but it's not does not appear in the bank statement. So obviously, this is a deposit in transit, which we have recorded in our own books as an income, but bank is yet to report it. Now, there's another check for the amount of 470 issued to officer. This is a transposition error. So we recorded $470, but the actual payment is 370. So difference, we need to remove the difference from the cash book. Then there's a note receivable of 9,800 that was collected by the bank. That means the bank has already recorded 9,800, but we are yet to record that in our own books. Note receivable is like a customer has paid into our bank directly, but we are yet to know about that payment. So we need to put that back into the cash book. There's another check of 520 deposit paid by the company has been charged back as NSF. So this NSF, not sufficient for we have recorded that amount in our books as an income, but the bank has later rejected that payment because the issuer does not have sufficient. So these are the observations from on the book. So this is what you need to do when you are doing bank reconciliation. Examine both statement and see what is in one and not in other, and then you start something like. Then you prepare your statement actual. So the first thing we start with, of course, you need to put the name of the company and the date and everything, but I don't have time for that. So just go straight to the issue. First, we need to start with the cash balance as per bank statement. As per bank statement, we know that that is what that is 300,000. Then we need to add some things. What are the things we need to add? Deposit in transit, because we have recorded that trend in our cash book, but we're yet to the bank is yet to add that amount. So you say you add a deposit in transit. You can bring that to the side here as what 20,000 dollars. Then another thing we need to add is I think that is all. I think that's all. So we can bring this here actually. Just bring this here. 20,000. Keep this formatting so we're doing properly. So that is all we need to add for this place. We can sum this place up. Then for the deductions, what are the things we need to deduct? We need to deduct unpresented checks, because there's a check that we have issued but it's yet to be presented at the for processing. That's this check we issued 50,000, so we need to deduct that 50,000 unpresented checks. The 50,000. And that's about all for the unpresented checks as well. So let me just move this to the side, and then can overrule this one. So this side will be okay, at this minus this. So this is the actual balance, 270,000. This is what the bank is supposed to report to us. However, this one you can just put negative here if you want, and sum this instead. You're still going to arrive at the same answer because we say deduct, so this should be in bracket or in jacket. So this is the actual balance. Then we can now start from cash balance as per cash book. So we know that the cash book says 260,900. So what are the reasons why this is not the same? First, we need to add back the income or money that the the bank has put there, but we are not aware of it. For instance, it's an income of $20, so we can bring this income here, 20. Sorry, I didn't give interest income, $20. We are not aware of it. Another income is the what's this? I think there's a 9,000, yeah, a note receivable of 9,000. This is money that was collected by the bank, but we are not aware of it. Probably customer paid. So a note receivable of $9,800. We're not aware of this, so we need to add those back. So we can just sum this. So let me just grab this side. I need to add this and just okay, and then sum this. So then there's some deductions that the bank has made. We are not aware of them. So like the NSF. So the NSF comes first. We know that bank has debited or been credited us the later debit that amount. We are not aware of it. So this check of 520 deposited by the bank has been charged back as NSF. So we need to remove that 520 from our books, like so. Then we also have there's a charge of $100. Where is it? This bank statement contains 100 service. So bank charges, we should remove that. Bank charges of $100. And then lastly, I think there's an error of transposition error of 470 instead of 370. So we should remove that error. I just say transposition error of $100. So if we sum this up like this, let's sum this here. I'll drag this, and I'll underline this one. And if we deduct 70 from this, you have 270 as the balance, which is also the same thing with bank balance. So this is just the process. Of course, there are templates for bank reconciliation statement, but if you do not understand the actual process, there's no way you'll be able to utilize any template out there. You can search for any template on the internet you see, but this is how reconciliation statement is done. Make sure you get those two statements. The first thing you need to do is to examine the statement and see what transaction is in one and is not in the other. So you bring them out and you will see that you realize that that is the difference. So you start with the cash balance as per the bank statement, then add money that you have recorded in your own cash book but is not in the bank statement. Add it to the bank balance, then deduct checks or payment that you have issued out to vendors or suppliers, but the bank has yet to report it in their books. So if you do that, you have the actual balance as the bank statement. Then if you start with your cash book balance, from the cash book balance, you add money that bank has recorded in their books as credit to your book. They maybe a customer pays you directly to your bank, but you are yet to receive it. You are yet to be aware of it because you have not collected your bank statement. So you should add that income to your cash book balance, like interest income, not receivables, and then you deduct direct charges. In some cases, you have some standing order or something like that the bank has already made on your behalf, but you are yet to record it in your cash book balance. So you should deduct those transactions. NSF too, you will find NSF in bank statement when you have them because money that's already been you have already recorded it as an income, but the bank later removed that money from your bank because there's the issuer does not have enough fund. Bank charges, this transposition error, the bank does not have this transposition error, but you have recorded, so you have to remove it. to arrive at this. So once you examine both statements, you draw out those transactions that is causing the problem and you put them in appropriate places. Using this technique, you can resolve any bank reconciliation statement, and then you should have a balanced statement at the end of the day. So thank you very much for listening to this one. If you have any question, please don't forget to drop it in the comment section. If this video is helpful for you one way or the other, please don't forget to like and share it with people that may also be of value. So thank you, and I see you another time. Goodbye.